Good morning, class. Today we discuss what is project appraisal. Right? Project appraisal is a very important topic in entrepreneurship development because first of all, I am telling you the meaning of project appraisal. Then we will discuss all the methods why project appraisal is important. We will discuss here. Right? Project appraisal is the analysis of cost and benefit of a proposed project with the goal of assuring a rational allocation of limited funds among available alternatives. Each and every business has limited factors, financial factors, and you have so many options, say n number of options available with you, ki what you produce, where you produce, what product makes you use. Okay, but you have to go for the best project which offer you more benefit and which bear less cost. This is a rational allocation. It means you have to apply certain formulas. On the basis of those formulas you decide which alternative is best for you. Always go for cost benefit analysis. Project appraisal is identify and values the expected cost and benefit of the project, and on the basis of that we compare the both the real cost and the benefit, and the real profitability is assured, certained. Okay, on the basis of that we decide the project. We have certain methods for the same methods of project appraisal. We have a very first method, that is payback period method. What is that payback? Payback period is the length of time required to recover the initial cash outlay on the project, right? What is the length of the project to recover the initial amount invested in the business? Initial outlay means initial investment. Say I am investing 2 lakh rupees in the project. What I expect from the business key, the cash flows, cash inflows, that is the outflow, na cash inflows in terms of what do you earn annually. Say rupees 50,000 in first year, 80,000 in sixth year, 60,000 in third year, 40,000 in the fourth year, and so on, right? So if you want to recover 2 lakh rupees, you, when we calculate by applying this particular formula which is very much in your screen, then we will get key in how many years we will get that 2 lakh rupees in the business back. So I'm telling you the first formula how to calculate it, that is payback is equal to what is the initial investment. It means that is 2 lakh rupees. Annual cash inflows, annual cash, you have to add the annual cash inflows, right? Like 50,000 plus 80,000 plus 60,000 plus 40,000. Then in how many years you recover the amount. When cash inflows are uneven, first point was कि when cash inflows were even, means in every year you have the same amount of cash inflow. But sometimes you feel like this कि cash inflows not equal. Say in first year say 50,000, in second year 40,000, in third year 90,000. But in the first case when they are even, then that is if 20,000 20,000 20,000 each. So you go for this formula. So in the case when cash inflows are uneven, we have a formula of E plus B upon C. E means year immediately preceding to the year of recovery. Year immediately preceding to the year of recovery. B means amount left to be recovered. C means cash inflows during the year for the final consumption, right? Now the main point that is important here, we have to compare the amount the year we calculate and what is your in terms of what is your standard. When we compare the standard with actual, say I have only single project and my answer is 3.25 year, right? But my expectation is 5 year. When we compare the expectation with the real, then we definitely accept the project, because my exception was 5 year, expectation was 5 year, but my real time is 3.25 years, so I will accept it. Say I have two projects, project A, project B. Project A has 3.25 year and project B I have 4 years, so I will accept which project? Obviously project A, because it has less number of years required to recover the original investment invested in the business, right? Then and you please go through the advantages and disadvantages. That is a very that was very easy topic, that's why not included in this, right? Then we have Average rate of return method. What is the average rate of return method? Average rate of return is considered to be improved over the payback period method. It considers the earning of the project during the entire economic life of the project, right? Means you consider the earning of the project during the whole life, economic life of the project. It is known as return on investment method. Return on investment is a ratio of earning after depreciation, okay, after depreciation, okay. And I have two formulas for the same. Point number one is return on ROI, return on investment, how we calculate. That is operating saving minus in initial investment divided by economic life of the machine divided by depreciation into 100. We have different formulas now. You may use any formula to calculate the same thing, right? So if suppose I have two projects, say I have two projects, project number A and project number B, right? Project A, total investment is 25,000. Initial investment means C0, everybody know. In case of B, that C0 is 37,000. In expected life for first project is 4 year and second project is 5 year, okay. And say they given you net earning after depreciation and taxation given in the question, okay. How you will get the amount? Obviously average investment, when you, if you want to calculate now, so what is your initial investment plus 0 divided by 2, you have average investment. Similarly you will get the average return. You have 5 year data given, 5 year amount given, you divide the amount divided by 5, then you will get the average return. When if you want to calculate the average rate of return, simply you have average investment and you have average rate of return in 200, we will get the answer. But both the projects satisfy, if say both the projects satisfy the minimum required rate of return, if the projects are mutually exclusive means if one project is accepted then another project is rejected, right? If they are not mutually exclusive, there are no budget constraint, both projects will be selected by you, right? Now we have some discounted cash flow techniques or modern techniques on through which we can calculate, because in the last two methods now there are certain limitation. Number one is they not consider time value of money, they not consider the amount come after the, you know, say your CO is recovered in 3 years, then after what income you earn you not consider anywhere, right? Then we have one more point, one more method, that is NPV method. What is that NPV method? NPV method is something related with net present value method. This is a modernized method. You have given certain points, you have given certain 10%, at 10% rate they give you some amount, 20% they gave you some annuity value. That on the basis of that annuity value now we calculate easily the amount to be recovered in 1 year, 2 year, 5 years, 7 year, and so on, right? So that is again very important thing. Now now we have the formula how we calculate that NPV. Okay, first thing is cash inflows and outflows you have to determine first, because if there is no information given about the cash inflows and outflows, you, how can you calculate the things, right? A discount rate and cutoff rate is determined, because if discount rate is not given in the question now, how can you calculate key in how many years you recover the original investment, right? Then we have, with the help of that rate of return, we easily calculate whatever the formula given on your screen, we can calculate the value. But you have to multiply your inflows with the rate which is given. Say at 10% rate, say I have a percentage given about 981.981 in the first year, 0.826 in the second year, 0.75 in third year, 0.683 in fourth year, and these are given in the annuity table. You have to follow that, right? Now, how we calculate NPV? NPV is always equal to present value of cash inflows minus present value of cash outflows. Why this method is so good? Why we treat this method is a good method? Because it take care about the time value of money, right? And an investment are essentially current capital outlay incurred in the anticipation of the future return. The timings of expected future inflows is extremely important in investment decision. So here there are three terms. One is discounting. We use discounting. Discounting is a basic operation of discounting cash flow method, right? Another thing in discounting method, what we use the discount rate, that is very much used in NPV method. I'm using here this particular term. And also we use discount period, say 5 year, 6 year, 10 year. So the silent advantage of this method is that that indicate that the value added to be the total asset of the firm, right? NPV criteria automatically allow the recovery of the initial investment and interest cost of investment, right? And the most important thing is maximizing the welfare of the owners, but there are certain limitations. It is difficult to use because methods are like first time when you use this method now, you feel, yeah, so many calculations are there, and a bit difficult. It may not give satisfactory answer when the projects being compared involve different amount of investment, right? When different amount of investments are given, then this method not give you the correct answer. Now we have the next method, that is internal rate of return method, right? I think something goes wrong. I'm again sharing the screen because there is something wrong in it. See, I have another method, that is okay. Now we have internal rate of return method. What is that method? This is again a very important method, right? How we calculated this method is again based on that NPV method only. In internal rate of return method, some of the other name of this method are discounting cash flow method, yield method, time adjusted method. In this particular method, we try to calculate the present value by using the formula initial investment divided by the annual cash inflow, right? First of all, we have to calculate the PVF from the table given year wise. One value should be higher and one value should be lower. Take the discount rate of those higher and lower values, calculate the present value of the cash inflows with the help of that discounting rate. You have to take care that factor. You use this formula. Internal rate of return is equal to lower rate plus NPV at lower rate minus present value factor divided by net present value at lower rate minus net present value at higher rate into higher rate minus lower rate. When you calculate it now, it will be very easy for you, right? The decision rule under IRR method in case of an independent investment, accept the proposal if its internal rate of return is greater, right? If lower, then you reject it. In case the mutually exclusive projects, accept the project which has higher internal rate of return and reject if the rate of return is lesser. You understand that this method is a very good method. Why a very good method? Because it take care about other than the depreciation, the entire cost, reducing everything, obtaining the capital cost. Often this will present value because the amount spent is spent in a base year. And also there are certain merit. It is a psychological appeal to the user. It is expressed in percentage figure. It is also consistent with the firm's objective, right? Now we have to understand what is the difference between what is the difference between NPV and IRR? What is the difference between NPV and IRR? It is present value of cash inflow less present value of cash outflow, right? Internal rate of return means it is the discount rate that makes NPV of all the cash inflows of the project equal to zero, right? NPV means it is expressed in the form of monetary returns, right? It is expressed in the form of percentage return. It is an absolute measure in case of NPV, right? It is a relative measure because a percentage we consider, if higher the percentage you accept the project, if lower the percentage you reject the project, right? This method can be used to evaluate the project and investment plan where there are changes in the cash flows. Here, this method cannot be used when changes takes place in the project, right? Now, we will discuss here what is profitability index method. Profitability index method is again depend upon internal rate of return method and your NPV, net present value method. Okay, in this method is known as benefit cost ratio method. It is based on net present value method. How we calculate it? Obviously, present value of the cash inflow. What do you earn? Multiply by the annuity value. You have to make a total, then divided by the present value of cash flow, what you initially invested in the business. There are options, decision, how we take the decision. If your present profitability index is more than 1, accepted. If profitability index is less than 1, rejected. If profitability index is 0, then it is up to you. Either you accept the proposal or reject the proposal. But this is in case of single project. But if you have more than one project, in that case, if higher the NPV, it should be selected. But why we study profitability index method instead of using other methods? What I suggest you, always, if suppose you join a company, even then you rely more on that NPV method and internal rate of return method. This will treat it as a you can say the last option when you really appraise your project, because this method is ultimately the sum total of the previous methods, because that first NPV method and internal rate of return method, they are good. But if you want to additionally inquire something, in that case, even that particular method is also good. Thank you very much for a day. We will come with a new topic tomorrow.